Hi, everyone. Welcome to the webinar. We're going to give it just about 30 seconds to a minute here, let everybody get logged in, and then we'll get started. All right, it looks like so we'll go ahead and get started today. Thank you for attending the flood insurance market webinar presented by Burns & Wilcox. Appreciate everybody taking the time today to join us to talk about a few exciting things, the state of the flood market, as well as some expert insight from our guest panelists. My name is Brad Turner. I'm Associate Vice President, National Product Manager of Flood for Burns & Wilcox. I'll be hosting the webinar today. Just as a reminder, you do have the ability to ask questions during the webinar. Everybody's audio is muted just to make it a good experience for everybody. You do have the ability to ask questions in the chat. You'll see the tool available to you. And there you can see it on the screen there. So you can submit your questions there, and as time allows, we'll be sure to ask our panelists as we go along to discuss. Again, my name is Brad Turner. I'm National Product Manager of Flood for Burns & Wilcox, where I've spent the last 9 years of my career out of the Morehead City, North Carolina office. My career started as a personal lines underwriter with Burns, where I've specialized in cat exposure, particularly wind and flood along the Atlantic Basin. My passion for flood underwriting transitioned me into a larger role with Burns, where I became the National Flood Practice Group Leader. I currently help manage our flood relationships from a carrier and a client perspective. Also been heavily involved in implementation of risk modeling within our national portfolio, as well as some data-driven initiatives in technology within the flood practice. Today, we're joined by my counterpart on the flood practice, Jacob Martin. Jake has spent the last 9 years with Burns & Wilcox, where he currently serves as the underwriting manager for our flood practice. Jake started his career as a commercial lines underwriter when he transitioned to the flood practice about 6 years ago. Within his role, Jake is responsible for managing the business workflow of our specialized headquarters underwriting group for flood. Within his tenure, Jake has been heavily involved in our risk modeling processes, technology implementations, and development of our underwriting philosophy. Jake also specializes in data analytics, holding an MS in data science and business analytics, in addition to a BS in risk management and insurance and mathematics. Jake, welcome to the webinar. Appreciate you joining us. And then we have Chris Grasso. Chris started his insurance career after a stint in the U.S. Navy. Started as an IT coordinator for a retail agency, transitioning into a personal insurance management role at the agency level. Chris was living in New Jersey during Superstorm Sandy, which motivated him to further his flood education and achieve the ANFI Associate National Flood Insurance designation, setting an educational foundation to better understand flood insurance, as well as the inherent gaps that exist within the standard policy form to the NFIP. Chris has gone on to achieve an AIS Associate in Insurance and CPRIA Chartered Private Risk and Insurance Advisor designations, which have further cemented his ability to consult and advise within the flood space. Chris now sits as brokered sales manager of Flood Flash, which is a cutting-edge parametric flood company that supports flood coverage in the United States and abroad in the UK. Gentlemen, thank you for joining, and certainly appreciate the audience being here as well to kind of view this conversation, the state of the market, and just get some insights from different perspectives. Kind of want to set the scene, guys. So we'll dive into the conversation as it stands and kind of set the scene for what the market looks like right now from a flood perspective. We're kind of coming off the heels of a pretty active storm season last year, with the culmination of Hurricane Ian kind of making landfall and the west coast of Florida, coming across the state into South Carolina as well, and affecting a big part of the Atlantic region. This was already kind of on the cusp of a severely hardening property market. We've seen the property market kind of shift into rate hardening. Now we're seeing obviously a lot of things changing, entering one of the most challenging reinsurance periods that we've kind of seen in recent memory. A lot of it's probably, predating our respective insurance careers. All of that combined with obviously a post-pandemic inflationary environment, which has really kind of exasperated the conditions in the property market overall in the U.S. We're seeing a lot of carriers that went through reinsurance renewals where they're, doubling down on retention. The cost of reinsurance is obviously exponentially higher now moving into the 2023 term. So we're seeing a lot of carriers reduce catastrophic exposure, also paying attention to specific perils at closer attention, flood being one of those. That to make things a little more challenging, not that we didn't have enough going on, we obviously had the NFIP 2.0 risk rating launch a little over a year ago, which has kind of flipped the flood market in the U.S., kind of upside down a little bit. So we've already seen increased mobility to the private market, and a lot of agents, clients, being it's a young kind of avenue within the private market for flood, especially primary flood, really trying to search out options within the marketplace. And it's, they're looking for more competitive pricing terms, but also looking for capacity. So a lot of these things we'll kind of touch on as we go through the webinar. So to kind of dive in, we kind of set the scene. Jake, can you kind of, from your perspective in your underwriting role, can you kind of describe some of the challenges from your view in this market and how they're affecting the flood market overall?
Yeah, for sure. And hi, everybody. First of all, Brad, you brought up a lot of stuff there, so I'll kind of pick off of those. So I think the first one that we've really seen a big push with, especially from our London suppliers, has been in relation to just valuations. So reconstruction costs have gone up. I think people are seeing that they've gone up pretty dramatically. Our Lloyd's suppliers have kind of come down the pipe asking for usually about $125 minimum on residential risks. Commercial risks can vary quite a bit more, but just even on a increase at renewal, we see markets asking for 5 to 7% minimum in terms of the reconstruction costs, just in consideration of the total limits there. So in general, I can't remember a time when inflation has played such a big role in just everyday conversations, particularly about our insurance. And I think the reconstruction costs have also led to people seeking out excess flood in a way where they really haven't ever done before. As most of our listeners are probably aware, the NFIP is a maximum of $250,000 on the building limits for a residential building and $500,000 on a general property form risk. That's just simply not enough anymore. People are looking to protect their property, especially on the exposed layers, and so they're seeking excess flood in order to do that. We've seen submission counts skyrocket over the past several months, kind of going back to when Ian happened. This has led really to pricing increases across the board. There's limited capacity, and Ian didn't really help that trend very much. Several markets pulled out after Ian. We've seen several markets that had heavy losses and they weren't charging enough rate, and because of that, there's a lot of scrambling going on down in Florida in particular just to find coverage. And so clients, there's times when they just can't get what they need. There's times when they're just told no on getting coverage. So think some of those larger homes down in Naples or Collier County, particularly Gulf Coast Florida has been challenging. We're still writing down there, but it's just that there's a lot more cherry picking going on in terms of good risks, whereas before there was a lot more capacity available.
Yeah, it's all good points. And you mentioned capacity. What are you kind of seeing from the capacity standpoint? Because I think our audience, obviously being a big part of our audience is from the retail perspective. I think it's sometimes when we hear capacity constraints, it can be isolated to a particular carrier relationship. Can you kind of talk to capacity real quick and just how maybe this is a little bit different than what you're seeing, and maybe some validity of the capacity constraints?
Yeah, so in terms of capacity, oftentimes individuals, depending on how much the risk limits are available, they just might not be able to get the full layer. So if you're talking a home that's worth $10-15 million in total exposure there, they might only be able to get $1 to $5 million through the traditional markets. In terms of certain areas, you see where carriers have pulled out, and that's due to their London capacity, biting back and dropping their capacity. When you go back to what happened with reinsurance rates back in January, effectively what happened was that you saw the reinsurance renewal rates actually go up quite dramatically, and the retention, the attachment point where the reinsurance actually kicked in increased as well. And because of that, you saw that a lot of these London suppliers actually are taking on more exposure. So to mitigate that, you're seeing increased rates and the lowering of risk limits available.
Yeah, I mean, it's I think it's good perspective. It's good to, understand that the capacity constraints in this market it's a real thing. It's a supply and demand issue at this point. I mean, obviously, terms and underwriting guidelines and all of those things play into how we mitigate and manage that. But the capacity constraints are a pretty real thing. Chris, kind of turning to you, obviously your career started at the agency level. And I know you travel a lot around the country. You get perspectives from a lot of different avenues, including agents, retail partners, also the wholesale space. What are you what are you hearing in your travels and talking to various avenues? Can you kind of describe some of the difficulties in this market from the flood perspective?
Absolutely, Brad. Thank you for having me on, by the way. To dovetail into what Jacob was saying, what we're seeing across the board is that the regular P&C renewals are going up at such an exponential rate. Forget the flood. Across the country, most of the flood is being carved out of those commercial products, or it's also just raising the rate, overall rate of the P&C to such a level that clients, particularly in Louisiana, California, and Florida, are seeing rate increases between 80 and 150% on their P&C products. And it makes it very, very difficult for them to manage their own costs and then decide, okay, I'm going to go out and get an elective coverage. Like, I'm now going to buy some primary flood because I'm required for a lender, but now I want some excess because I know I have exposure. They just don't have the money and the capacity to go ahead and do that. So it really creates an issue that then goes and propagates itself. So they go to we'll self-insure it. And that just creates another problem, because if they do self-insure and then we have a catastrophic storm like an Ian go through, they need the government money to bail them out. That creates problems, additional costs to them with loans and all sorts of other things. So it really is just a problem on top of a problem. And then the other thing that we're seeing is, if you look at what's going on from what we've seen from the catastrophic, particularly the flood going on in California right now, you've got a 12-foot snowpack out there in the Tulare Lake, which was dry, is now bursting. These levees that are out there are predicted to fail, and the entire basin is supposed to be underwater. Now, I've gotten multiple requests for people like buying all sorts of limits out there, but it's considered an active flood event. We know it's going to flood. We just don't know how much. It hasn't done it in years. It hasn't been an area of concern, and now it's a huge area of concern. Fort Lauderdale just recently went through what they did with those heavy rains. Again, not an area of huge concern for something like that, but they just had a huge event. The issue is the traditional models don't necessarily apply to what's going on in the marketplace, because where we expect flooding to occur, we know that Florida is going to have a hurricane. We just don't know where it's going to happen. We expect that that's going to happen, but all these other random, or what seem like random flood events in non-traditional flood areas is really causing a problem. So everybody has some sort of an exposure out there, and as difficult as it is, it's better to prepare for it now, put the cost in there, because I think at the time you actually need the coverage, it's going to be too late to get it.
Yeah, you mentioned a couple good points there. I appreciate your insight. I think it's a difficult market as it stands, but you're dealing with a situation now where we're seeing a lot of these events with climate change affecting areas that we can make arguments for climate change all day, but certainly there's proof in the pudding a little bit that we were seeing events happen outside of wind season. We're seeing non-traditional areas flood more frequently. Flash flooding is, in particular, is going to be a higher issue as we move into the next decade. You're going to see sunny day flooding, nuisance flooding also kind of be a big thing. And then on top of that, you've got the wildfires that have kind of decimated, some of that western region. That all goes into flooding. That exacerbates flood risk in those areas ongoing for the next, 5 years approaching. So and then snow melt on top of that. We haven't entered wind season yet, full force. So it definitely predicates a different environment. Ian, perfect example, like you said, Chris. 15%, I think, is the last statistic I saw, where you have 15% of the path of the storm uninsured, or excuse me, that had flood insurance on a primary basis. So you're looking at an 85% level of uninsurance for that region. That's pretty incredible, considering the the exposure in Florida. You think about some of these other areas where it's perceived not to flood frequently, to predicate flood insurance. It's definitely a different environment. Certainly something people should focus on when they're approaching flood insurance moving forward. Kind of pivoting back to you, Jake, on some of the things that Chris talked about, as well as yourself. Obviously capacity, we already kind of touched on it. It's being constrained, and there's pockets that we're probably seeing this affected a little more so, be it in coastal regions, or even California now experiencing some of the things that it has. Can you kind of talk to some of what you've seen from a constraint level? In other words, what are you seeing trending? Could be underwriting characteristics, non-renewals, particular areas in the country where you're noticing things, or even like underwriting focus that we're seeing for the first time. So kind of touch on that.
Yeah, I think just first, you mentioned non-renewals. I think that's a great place to start. As we talked about capacity, that all kind of trickles down the pipeline. And so we've seen many carriers who are non-renewing a lot of risks. I'm sure people on the call are very familiar with that. The risks that some of these carriers that have lost capacity, that aren't being dumped, they are they're being dramatically increased on their renewal rates. And the reason they're doing this is because they have a very poor performing book, and they need to increase the performance of that by changing what's actually on that, whether that's through rate or through non-renewal. So the capacity issue is driving a lot of the decisions that are going on with carriers that are in the marketplace. Much of the pricing and non-renewals that you're seeing are either Gulf Coast, whether we're talking about Florida, going up Mississippi, Alabama, Texas, and then also just along the Atlantic side as well. We've seen a lot in the coastal South Carolina area, coastal North Carolina. So particularly in regards to Florida, I think the thing that makes Florida so difficult from a flood perspective is that so many of those homes down there are one story, high value, and they're typically low lying. You see a ton of those, and that's a recipe for large losses. So large probable maximum loss, PML values, and you're going to see that all up and down the coast of Florida, is these low-lying homes. And just to give an example of that, we can look at areas like a Cape Coral or like a Naples, and we see where the house is on slab at maybe 8 feet above sea level, but you end up seeing storm surge on Cat 2, Cat 3 that surpass 16, 18 feet above sea level. So you're talking about very high storm surge in regards to where the first living floor of the home is, and that's from even an excess layer that's borderline unmanageable. You're going to see dramatic rates, things that people just don't want to pay. There's been a lot of pullout in those areas because people have kind of woken up and realized, like, hey, this is not the right rate. This is not the right price for what we're actually offering them. So that's a big piece, is carriers are looking for sustainable underwriting. I can't use that word enough, sustainable. They're looking for risks that are built adequately to sustain against storm surge. They're looking at the long haul. So those are the people who are being given capacity right now, are the people who are saying, hey, we're going to model a book that looks good over a 100-year period, or even farther out than that. They're looking for that sustainability in the long haul. And then, we already talked about reinsurance, but like you said, Chris, like people are seeing 60, 70% reinsurance markets increase their rates. And I think that played a big piece into the capacity, as we mentioned before.
Yeah, it's all good points. Thank you, Jake. I mean, in Florida, we kind of saw it. You mentioned the surge exposure there. I think it's a hard thing to imagine, but you can obviously look at the aftermath of Ian and the wall of surge that came through onshore in those areas. And unfortunately, a lot of the risk management with flood is done at the community level. It's done based on construction characteristics, how many stories, is it elevated properly, all of these things. So I think you're getting an exasperated situation there for sure. But that's good insights. Chris, kind of moving, we kind of set the backdrop now for the flood market and kind of some of the challenges that agents are facing, as well as consumers, also in the wholesale space trying to place insurance. It does bring up kind of, with reduction of capacity along the coast, we're seeing kind of an interesting dynamic that parametric flood, your specialty with flood flash, it does kind of pose an interesting solution for the market. So can you kind of explain how parametric flood coverage works at a basic level and how that differs from traditional insurance?
Absolutely, Brad. So the thing with parametric flood, and this is probably the biggest thing why parametric can be the solution, almost a silver bullet, in that when you talk about the traditional marketplace that everybody's familiar with, you buy a limit, $250,000, $500,000, $1 million, these $5 million limits. And then the carriers that have those write that risk 10, 20 times in, say, a particular neighborhood. Now, what they're hoping for is that when the flood event occurs, they don't have a major event. Because if they do, they've got $5 million out, say, on 10 different risks, or an exposure of $50 million, and they don't really know when the claim hits what their actual payout's going to be, not until after the claim's occurred. The biggest difference with parametric is it's a fancy word that simply says, if you meet a set of conditions, then this happens. In the case of parametric flood, it says, if the water hits a certain level, we will pay you this amount, and you pick that amount. So it's done, and you'll probably see this a couple times. This is a mock of the actual sensor itself. You can see it's not that big. The real one is PVC white, but this is clear with some of the technology built into it here. So basically, the sensor gets mounted directly at the risk location. It's physically mounted to the building. And then the client picks the trigger depths and the amount of coverage they want. So they can have multiple triggers on one depth, or one sensor. So if you will imagine that often floods come in like multiple sizes. You can have a small flood, that nuisance flood. Maybe you get 8 inches of water, just kind of like touches the floors, and you got to do some cleanup. Not going to be out of business a long period of time. With the parametric solution, you could buy, say, $50,000 of coverage at 8 inches. And then you want to say, well, you're also subject to possibly a larger flood, say 2 feet. 2 feet is going to cause more damage than 8 inches. You might have some additional expenses to pay for. Maybe you want $100,000 at that. And then you can buy the storm surge type event, that kind of Ian event that says, okay, not supposed to happen, but it did happen. Now I've got 6 feet of water, and now it could be months before I'm back in business. So I want to buy $500,000 at that level. What that allows you to do is control your costs based on the amount of money you will actually need to get yourself back into business. And with our parametric solutions, a little bit different is the monies that we provide you, they're immediate. Okay, so once the trigger gets met, we just wire the money to your bank. It's usually paid to you within 4 to 7 days, depending on which bank you're with. So you've got the money to do it, what you need immediately. And that money can be spent on anything that's related to the claim, whether it's business income, whether it's building, whether it's contents. There's no limit. There's no policy language that says you must pay for X. So there's not even a limit, we'll talk about this later on, that says you must have direct physical loss to your building in order to get paid. There are different things that you can do, customize things. So it's a much more broad way to do it. But the other thing is the reinsurance behind the product. They know exactly during a storm when, like Ian was coming aboard, they can easily just count the sensors, see what the limits are on that. They know what their total loss is going to be. If every sensor in a certain stretch was to get hit, they know it's going to be an X dollar loss. It's a fixed cost for them, which makes it much more sustainable, to Jake's point, that they know what they can do. So they can be like, okay, we don't want to take any more risk on in this particular area because this could be too large and not sustainable, so they can slow down. So it's just a very specific way to keep track of everything that's going on and actually give clients what they need to recover.
Yeah, I think you made a couple good points there, and I want to kind of reemphasize, parametric coverage. It's a customized solution. So obviously, you guys are doing a lot of consulting, a lot of evaluation for clients to help kind of collaborate on the best option. The budget thing and being able to kind of adapt it to the situation, I think is a good point. This coverage is designed to be a highly customized solution, and really it's meant to not only offer additional coverage or maybe fill gaps in coverage, but it's offering some unique solutions. You kind of touched on it, but like indirect loss, for example, something that's traditionally hard to cover. And then you've got areas obviously that are traditionally hard to cover within the private space, such as like New Orleans, for example. You've got a solution here that not only pays out very quickly, there's no adjustment process, which is part of the pain with flood. I mean, we run a traditional flood insurance program. We have private TPA, and we have an efficient process, but there is obviously that adjustment period, especially in a CAT event. Having the ability to get payout right away in a timely fashion, that's a big point. And then be able to use it however you need to for the property to get you kind of back running quickly. That's just a huge advantage for this type of product. Jake, I'll kind of pivot to you. And we've had a chance to collaborate with Chris and Flood Flash over the last several months. Can you kind of speak from your perspective? What are some of the important considerations when we're evaluating for parametric flood, and when we might approach, Chris and his team, and maybe some considerations? Maybe it could be characteristics or things that you're seeing that you'd want to approach for parametric flood. And it's important to mention too, this is it is a commercial risk type of product at this point. So I don't think we've mentioned that at any point, but anything else within your evaluation, Jake, that you would want to speak to?
Yeah. I mean, just from my experience so far with Flood Flash has been great. I think what Chris and his team are doing is super unique, and at least here in the United States, it's very unique and it's very interesting. There's a lot of applications that I think there's potential with. So we've been submitting a lot of like higher value stuff to him to look at for us. Think $35 million or more. Things you just have a really hard time finding coverage in your traditional markets, or even just high exposure type stuff that you just can't find a market to take on. Chris and his team have looked at some of that stuff, and they put a price on it for us. Chris has looked at some really interesting, unique risk types as well. Things you just can't cover with a traditional market, such as golf greens. We've looked at a car dealer lot, insuring the cars like on the lot. A bridge type situation. I think you told us before you've insured like carnival rides on a pier, like pretty interesting stuff, right? That's not something you can get a traditional flood market to offer coverage on. Part of the definition of a flood in the flood language is going to be that it has to be a building, it has to meet certain qualifications. At a mathematical level, parametric is actually very simple and it's very interesting. I think the big thing when you're actually talking about parametric is just really training folks to have that conversation. It feels like there has to be a shift away from, what is the competitor's pricing and let's kind of slide under that. That just doesn't seem to work as well. I think when you talk about this with clients, it has to be, hey, what's your budget? And like you said, let's customize a package that kind of fits and meets that box. Especially in risk exposed areas, some of the pricing on this stuff can be pretty high. So you kind of have to be aware of that up front. It doesn't necessarily, but it can be pretty high. This is a pretty new topic here in the United States. And so I think the other big aspect is partnering with a flood specialist who actually understands modeling and can speak to a lot of that and can actually give advice. I think those are some of the keys here.
Yeah, it's all good points. And, you kind of brought up some interesting, Jake and I are kind of, flood geeks at this point. We get really excited about, newer products, but things that you can't traditionally, one of the things that we really, the first meeting we had with Chris, I think we spent probably an hour longer than we were supposed to with him, but he was kind enough to talk about some of the interesting situations, and we were just kind of throwing out stuff, and there wasn't much that he said no to. So I think it's, you kind of build on it. This is not a market of price. This is a market of, this is an insurance product. It's made to offer a solution in high extreme areas or situations. And it does make sense from an insurance perspective. It also makes sense for the consumer, especially when you consider the audience. The audience is a commercial entity. They have a much higher, entry level to limits exposure, and they also are the indirect loss as a result of that. This is a product that helps them get the business moving still. So it can't be understated. This is not about price so much as it is about opportunity to insure and keep moving the business forward, where you traditionally would have a hard time and you kind of have a stopgap in that. Chris, coming back to you, Jake he mentioned a few things in there, but I kind of want you to build on it on a little more detail. Obviously we've talked about it being a customized process. Can you kind of talk about the modeling factors that may go into this? And he mentioned that it's important to understand modeling, at least at a basic level, so you can kind of customize or understand where your risk is coming from, how you might maybe put the sensor on the building, et cetera. Can you kind of speak to the sensor placement, the trigger points, how you guys customize, maybe some of the modeling factors, and then some of the cool risks too? I think the audience would really enjoy hearing some of the cool stuff that you've been able to insure.
Absolutely. So for the audience, just want to let you know the commercial for us is defined as anything that's income bearing. So that does include Airbnb, VRBOs, if you're renting out a room, if you've got a basement apartment, and the structures creating, if you even have a business in a back garage or something like that, where the actual property is generating revenue, it is something we can look at. So the size doesn't necessarily generate the price. We are specifically pricing based on what we feel the risk is at that location, specifically at that location. So what we do is we take a footprint, they're all done already, but we take a footprint of the building you're asking us to insure, and it could be more than one building, but let's just use one building for now. We take a look at the building and we look at what we think is going to happen using the models that we have should certain events take place. Now, based on that, we get back a quote document that allows us to look at it and realize, okay, the event is probably going to happen in this range. And so when we're going through picking out trigger points and stuff like that, it's important for us to look at how we do the sensor placement. So this is kind of like to what Jake said earlier. Florida is probably flat as a pancake, okay, and they don't have basements down there, or they'd all be pools. Now, up in the Northeast, which is where I grew up, everybody's got some sort of elevated something or other, right? Whether it's a basement or crawl space or something. So your first floor of exposure is often several inches from where the actual ground level is. But when we place our sensors, they get measured to the ground level. So when you're looking at trigger points, and we talk about an 8-inch trigger, and we might say, hey, you know what, here on this, you can go with easily a 20-inch trigger. That's because what we're looking at is before you get to the first floor of your actual living area where something will actually get damaged, you walk up 3 steps. And we know what those are, 8-inch rises, that kind of thing. So those are what we're going to do on the risk analysis when we're looking at certain properties, certain risks. What have you done? Are there any mitigation factors that are in there in terms of maybe you put up a flood wall or a flood gate or something like that to prevent water getting to the property, so it has to hit a certain level. So we're going to do all that evaluation and figure out, hey, make some recommendations as to what we see, what we think. We're very hands-on during the process. Through the whole process, we will speak to anybody who wants to be spoken to, walk anybody through to help them understand it, because we understand that it's a new technology to them. Even though it's built on old technology, it's just a new way to do things, to have a physical device installed in your building that measures water effectively. And because it is a physical device, to what Brad was saying before, is we get to do some creative things with it. So there's a casino in Mississippi that we write. The casino is way up on a hill and it's elevated, but it swings way down low next to a river. So the problem for the casino is if the river floods, their parking lot floods, and then they can't get any customers in there, that it gets shut down by the city. So they lose a tremendous amount of business income. So instead of placing the sensor on the physical building there, we did a custom solution where we actually placed the sensor out on the light pole at the end of the parking lot nearest the flood hazard. So that when the sensor goes off at the pole, they'll get paid their predetermined trigger. Same things like on the golf course. Most of the times, a lot of times, the golf course clubhouse isn't really the exposed area. It's the golf course itself. It might be the greens, it's the fairways, it's the landscaping to get everything up, the irrigation systems. And traditionally, you haven't been able to cover those things with a flood product because it's not a building. But those golf courses also traditionally have buildings out somewhere out on the golf course. most golf courses have a halfway house or a comfort station at least the ninth hole, and a couple others placed out there. So we can go find those permanent structures and place out there closer to the hazard. So when the water does come in, we can make that payment right away. Those are a couple of the specifically kind of cool things that we've done. There is also one in New Jersey where very similar to the Mississippi casino situation, where when you come over the bridge to get to where the amusement parks are, there's a very low-lying area that floods constantly. So we were able to get permission, because we don't own the bridge, from the bridge authority to place a sensor there for our client to measure the water there, because when the water hits a certain level there, they can't get their clients. And to Jake's point, and one of the things that is kind of fun is, because our product can be used for anything, we have found that it is used for non-traditional things, whether it's the open car lots with the vehicles in there, which usually can't be covered, or if you think about a boardwalk anywhere along the eastern coast, there's a couple out in California, but mostly it's the East Coast. You know, we can actually place the sensor on the pilings, and then when the sensor triggers wherever it needs to be, we can actually pay for the damage to the physical boardwalk itself, and anything that basically is above it, whether it's a ride or any of those little, gosh, I grew up in New Jersey on the things, I can't remember what they're called, where you put the quarter down, which is now $1, I think, and you spin the wheel and you win a stuffy. So we can insure those too. So it's really anything that you can think of, we can pretty much do it.
Yeah, we're trying to come up with ways to stump Chris, but he hasn't been stumped yet, so that's a good thing. But he's got a pretty good data source coming and supporting on the background. We haven't mentioned it, Chris, but can you kind of speak to the paper that it's written on just real quickly, because I think it'd be good for the audience to hear that.
Yeah, so the product is underwritten by Munich Re. Munich Re is our supporter, and their venture capital arm is also an investor in Flood Flash as a company. So they're a shareholder as well as the main paper.
Yeah, so that's a huge data source. We have had some questions from the audience about data and all of that, but obviously that's a pretty big data source, being one of the biggest reinsurers in the world. So Jake, you kind of heard some of the interesting applications for Flood Flash and parametric coverage in general. Can you kind of talk about maybe a different way to think about it? So there's obviously interesting situations to cover, but this can also be used to fill in gaps in traditional flood insurance. So can you kind of touch on that, and maybe how those gaps can be used, or excuse me, how you can kind of fill those gaps, but also maybe touch on when we should not approach parametric flood from that perspective?
There's really a lot of potential with this type of product. If there's a situation, and I think it's important to reiterate, a lot of times when people buy this product, it's because they want coverage. This is not for replacing a lending type policy. So think NFIP policy that they have in place for a lending institution. This is not to replace that. So this is more the wrap type situation where you're looking for business income, or as we talked about before, you can't get business income through the NFIP, or you can't get that. You can get that through other types of private markets, but the type of situation where you just truly want a big business income payout, you could use this for that. There's no adjustment on it, so you get a very fast payout that can be very, very valuable to people. I use that word value. It's important to remember that price is one thing, but value is another. And so when you're pitching this to clients, that faster payout does have a lot of value. As Chris mentioned, you can get pretty creative with how you actually place the sensor, where you place it on the building, and how it's actually there. So there's a lot of interesting creative solutions, as he kind of mentioned and hit on. Another potential would just be a deductible buy down, potentially, if you wanted to do that. So maybe you do a lower level trigger, and you're just looking for, let's say their primary policy has a $50,000 or $100,000 deductible. It could be the type of situation where you're using this as a way to buy that down. But yeah, I mean, there's tons of creative and interesting solutions that you could use this product for.
So Chris, just kind of building off of what Jake said there, anything you want to mention as far as interesting ways to use your product, and maybe maybe tie it back into the challenges we're facing in the market, and how can agents promote this parametric coverage angle to their clients to help them understand and maybe have a higher success rate?
I know for myself, when I was an agent, I got this question probably, and it wasn't just on flood insurance, it was almost on every line that I was selling, that basically was, I don't want to pay for what they tell me I have to pay for. I only want to buy what I need. I only want to buy what I think I need. I know that if this happens, I'm only going to need X number of dollars in order to get whole. And traditionally, you've always had to do, no, it's got to be 100% insurance to value. You've got to be at least 80% co-insurance. There've been some other factor there pressing you to say, no, you have to buy more than you may actually ever need. And it's because of how those programs are structured that you have to do that, with the way they do tapered payouts and upfront payouts and stuff. With our product, if you know you only need $30,000 in coverage for BI because you've had that situation, maybe you've had a claim before, and you know that that's what you went through and that's what you needed to get up and running, we can do that. We can just write a $30,000 BI policy. Now, we term it something like BI, we term it as something deductible buy down. I want to be clear that it's one policy. You can use it for all of those things. So when we're talking to a client, rather than using the terms parametric, it's when you've identified what it is that the trigger point, when I say trigger point, what the point is that the client's looking for, whether it is maybe it is strictly business income, and go ahead and call it a business income policy. If somebody's worried about a deductible buy down, then it's a deductible buy down policy. If it's a combination of everything, then it's just a flood policy. But in effect, it's always the same policy. The only thing that changes is the amount of coverage you're buying. So the thing to think about when you're conversing with the clients is, okay, what is their pressure point? What is their soft point? Maybe it is they need higher limits, because we can do higher limits. Maybe they want, ultra high limits that aren't available. Maybe they flooded a couple times in the past and they're getting no options other than the NFIP, and that's not enough limit and it has constraints. We can look at all of those properties, because again, we're going to take in flood history as a key factor into where the pricing and everything sits. So for the most part, we've been able to offer a price in everything that we've looked at. And to Jake's point earlier, yeah, sometimes if you've had the type of policy where you've had 3 floods in 5 years, and we know you haven't done anything to building to stop a potential flood happening this year or next year, that rate's going to be higher. Conversely, in San Diego, where we have some risks that had those multiple claim situations, they decided to take some of the money they got from their payout and they put it into flood resilience measures, where they put up a flood wall and floodgates where the doors are. Now that allowed them to take a trigger depth of over 36 inches, and the higher the trigger depth with our policies, the lower the premium. That's pretty common sense. And what that allowed them to do is actually pay less after they had their 3 claims than they paid before they had the 3 claims, because they took measures to prevent that nuisance, call it 2-foot claim, from occurring again. So there are lots of things you can do and be creative, because flood resilience is even something you can use our product for. So after it, you have the event, you've got this money left over where, hey, I'm back up and running, life is good, but hey, I still got this extra $80,000. What should I do with it? And you can go ahead and consult with a flood resilience company and go ahead and fortify your building.
Yeah, so it sounds like to me, you're offering versatility. Obviously, you're offering a flood policy that can be used in most situations to really adapt to what the insured is wanting, and that's kind of unique. We're kind of subject to the policy language and the exclusions that exist and all the the lawyer speak as it pertains to a lot of flood policies. It's a different perspective, and even for somebody that deals with flood insurance quite a bit, it's something that's been difficult for us to wrap our heads around as we're trying to kind of think about situations that we experience. So I'm excited about the parametric coverage. I think, on top of that, I think, Chris, you guys have already proven that you guys are about relationship, and that's something that we really pride ourselves on at Burns. So aligning relationship, consulting, advising, really customizing solutions that make sense for the insured, the consumer, that's what we're here to do. We're here to help them insure the risk that's involved and not try to navigate a lot of coverage exclusions, et cetera. So I think it's an excellent product. We do have time. We've got about a minute left. I'm going to touch on one question. We're about the end of the road, but there's a good question from the audience, and Jake, and also you can talk to Chris to this as well. Can you kind of touch on the effects of the NFIP 2.0? And Jake, we can start with you. And has it increased complexity, meaning there's more competition within the market, or has there been less opportunity for the private market than there was before?
Yeah, so just as a reminder, NFIP 2.0 kicked in, really, I think it was last October was when the new business, and then back in April, I believe, oh, sorry, I'm a year off, but it's been about a year since since the renewal piece has kicked in. And yeah, I mean, there's been a lot of shift over to the private market, has been what I've seen. I think people have kind of witnessed what's going on, and they're open to shopping their insurance, in particular that happens with in the private market. So just to add a little bit of context onto that, what I mean is that in the prior, the NFIP had a very flat rating method. So if you were in an X zone, you got an X zone rate. If you were in an A zone, you got an A zone rate. It didn't matter if you were right on the coast in Florida, or if you were 150 miles inland in a non-surge exposed area. So it was just a very flat rating methodology. But what they've actually shifted to is something that's actually much more akin to how the private market does it, where they consider replacement costs of the building, exposed values. They're looking at modeling and so some of those types of things. That's what we do in the private market. And so basically what that's done is it's created a lot more risks that where before you had the preferred program in X zones with the NFIP, that's gone away. They don't have that anymore. And so that in and of itself has opened up a lot of opportunity. So renewals, we've seen a lot of them where it tells you the pricing that they should be paying on that NFIP where it's locked in at, and it tells you what they're actually paying after the discount. And so we look at those all the time where they should be paying $9,000-$10,000, but what they're actually paying is $600-$700. And so they're going to be locked into that for a little while. And those types of things are harder to actually replace. And the price that you're seeing there is probably what they actually should be paying. But new policies aren't getting locked into those types of rating situations. And so there's a ton of opportunity there for the private market, and we've seen a ton of uptick on that.
Yeah, and we're out of time, guys, but just to kind of wrap it up with what Jake said, I think there's definitely increased competition. I think it's going to increase as we move further over time, where the NFIP does adjust its pricing. Obviously, a lot of these increases are going to compound over year after year, so it's going to take some opportunities. But we've heard about some great solutions today, be it with parametric coverage through Flood Flash, also traditional markets through our flood practice also available. Appreciate the audience attending. If you have any additional questions, there was a ton of questions and engagement from the audience, feel free to reach out to Jake or myself, certainly Chris as well. We can definitely answer any of those questions offline. Appreciate the audience attending today. Great engagement. Thank you, Chris. Thank you, Jake, for taking the time out to give us your insight. Excited about the parametric options and moving forward in this market. I think we have some great solutions to help our clients, and we're looking forward to assisting everybody moving forward. So everybody have a blessed day. Stay safe. Have a great day.
Thank you, everybody.